Hello, I'm Safietou Russell, founder and CEO of SDR Consulting. One of the most common errors I see taxpayers come to me with during tax season is not knowing what type of entity they own. This can affect how you're taxed, so it's really important to iron out those details ahead of time. So, if you're an LLC, if you're a multi member LLC, if you're an S corporation, if you're a C Corp, all of those could have different tax filings. And if you file them incorrectly, you're going to end up with notices and penalties and a big headache. So, it's very vital that you know what type of entity you owned and how it's taxed and what your due dates are. The second common thing I see is taxpayers just totally not being prepared for tax season, not knowing how much they made, how much their expenses were, what they were eligible to deduct. And really, that's more proactive work that's really important to do ahead of time and be doing that right now. Especially as we're heading into quarter four, this is the time to get an understanding of what's happened all year because you can actually implement some things before year end so that you know what to expect during tax season. Tax season is reactive, not proactive. Well, when you're not prepared, let's say that you haven't taken into account all the financials that have happened last year. So you're probably rushing, you're stressed out, you want to get taxes over with. So you're probably missing things, you're probably missing write-offs, and you may even be missing income, which the IRS may not find for 2, 3 years down the line. And then when they send you that notice, it's plus penalties and interest. Also, maybe you've missed deadlines. So, for example, if you're not sure how you're taxed and you're an S corporation or a partnership, your deadline is March 15th. And if you come on April 1st, rushing trying to do your taxes, well, you're already late. You're already late 1 month, and the penalty is $200 and something per partner per month. So, those are some of the costs of not being prepared. And it really there's time to be prepared. Life is busy. We understand that. But if you want to save money on penalties and interest, you want to be as prepared as possible. So the question is, do I see this happening more often with established businesses or startup businesses? And I would say it's somewhat even, but I think more prevalent with startups because they're so new that they're not sure of their requirements as a business owner. So definitely before starting your business, it's ideal to meet with an accountant and a lawyer to understand what type of entity you have, how that entity is taxed, what information you need to be tracking during the year so that you're better prepared for tax season. Some established business owners just get overwhelmed with the work and all the demands, and it just kind of out of sight, out of mind. So they may be aware of what they need to do, but there's so much stress in getting prepared and tracking and whatnot throughout the year that they just let it go by the wayside and are focusing only on their business. So that's why I see it with both, but I definitely see it more with startups because they're just not sure, they're not properly informed. So the question is, what type of penalties have I seen, and the business owners incur for not being aware of their filing requirements and their entity type? Recently, I've seen a $10,000 penalty for an entity that had multiple members. And that didn't meet their partnership deadline of March 15th. And so by the time they filed, it was maybe 6 or 7 partners times 200 times how many months that they were late. And so it can definitely rack up. So Tori from Arizona asks, as a 2-member LLC, how do you pay taxes? And that's a great question, Tori. First thing I want to raise is that it's important to know that your tax is a partnership, and a partnership has a March 15th deadline. So your taxes are filed earlier than your regular, individual taxes. As a multi-member LLC, this partnership tax return is going to summarize all of your income and expenses, and if there's a profit left, that profit is going to be taxed to the partners, to the members, of the LLC. Now, how much your tax is going to depend on your individual situation. So let's say you're a 50-50, partnership. Everything's going to be summarized on the partnership return. a K1 schedule. A Schedule K1 is going to be issued to each partner for your share of the profit. So if it's a $100,000 profit, you each will get a K1 that shows 50,000. You then combine that into your personal tax filing and combine it with everything else you have going on. So you could be working a W-2 job, you could have some investment activity, you could have rental property. All of that's going to get combined and determine what your tax liability is. So the partnership itself doesn't pay taxes, it is a flow through entity. That means the income or losses flow through to the partners and members, and the taxes you pay are determined at your individual level. With that being said, partnership income is also subject to self-employment tax, which is 15.3%. And so, in addition to your income tax, federal and state, you will have self-employment tax on a profitable partnership. So, how you pay taxes is when you file your individual return for sure, but also it's important to consider making estimated or quarterly tax payments throughout the year based on the profit that the partnership is having throughout the year. So you're not caught off guard. The best way to do this is to have a bookkeeping system in place for the partnership so that you can see your profit and loss throughout the year, take your 50% share if that's your arrangement, and combine that with your personal taxes, do a projection, and see if you need to make a quarterly payment. So I hope that makes sense, Tori. So Brooke from New York asks, when does it make sense to switch from an LLC to an S-Corp? This is a question I get all the time, and I'll summarize it with this. It depends on the numbers, right? Especially if you're in New York, Brooke, because in New York, depending on the area of New York you're in, your S-Corp benefits may be minimized because of New York City taxes. So in general, there's no magic answer of when it's a good fit because it's not just based on your profit. First, you want to understand what it takes to be taxed as an S corporation. Number one, you're going to still be an LLC or a corporation. You're making a tax election to be taxed as an S corp, which means that you're going to file an S corporation tax return. There's requirements on the shareholder who's providing services to have a reasonable compensation paid out to them from the S corp as a W-2 employee. And then you're going to pick up, so you'll have a W-2 from your business, and then you'll have also a Schedule K-1. So no taxes generally are paid by the S-Corp. As far as income taxes, it's a pass-through entity as well. In New York City, they don't recognize S-Corps, and so there is a C-Corp tax on the S-Corporation. So once you understand the compliance requirements, now you have, okay, a payroll service, unemployment insurance, so you have additional compliance costs, and you have a tax return preparation cost that's going to increase. So those are the things you want to factor in addition to the profit that you have, how much your reasonable compensation may need to be that you're going to pay payroll taxes on, and then what's your overall tax savings after you've done all of that? Does it really make sense, right? So when I do that analysis, it's based on the numbers. We factor all those pieces in and say, okay, here's what you would look like as an LLC, here's what you would look like an S corp, and does it make sense for you? Another thing to consider is if you have challenges making estimated tax payments, well, maybe a S corp is beneficial, even if it's not so much for the tax savings, but more for the reason that your taxes can be taken out during the year, and you don't have to worry about having a large bill at the end. Minimizing self-employment taxes, all that's important, but even if you just paid yourself as a W-2 employee to have more structure to your pay and the taxes you pay throughout the year, that's also a reason that an S corp could be a good fit for you. So a couple different scenarios of where it would be a good fit. It's not just based on a standard profit number. So the question is, should I elect to be an S corporation once I've hit 30K or 40K or 10K? And the answer is there's no magic number, right? It's because each individual situation is different. You could be making 20,000 from your S corporation business, but you also could have a sole proprietorship that brings you into a higher tax bracket. You also could have investment property or a huge cryptocurrency account that can affect how much you're taxed. So there's no magic number for your business alone to determine if an S corp is a good fit for you. Ideally, as you make more profit, there's potentially more savings, but because of the complexity in taxes, there's no set number that's going to work for everybody. Diego from Miami had a question regarding cash or accrual. What method is best for taxes? And if you have a business where your collection process is slow, maybe it takes clients 3, 4, 5 months to pay, which one makes more sense. So first, let's kind of go over the difference between the two on a high level. A cash basis taxpayer is someone that pays taxes based on the actual cash received and the actual expenses that have gone out for that tax year. So regardless of when the work was performed, if you received the money and if you paid out money, that's how your taxes are determined, which generally is good for, especially for smaller business owners because you actually have the cash available. If you made 50,000 and you need to pay taxes on it, you at least have received it. So with accrual, the taxes are determined based on you billing the client, sending them an invoice, and then the expenses that have been accrued. So for example, if you bill a client $50,000 and you've performed the work, but they haven't paid you yet, on an accrual basis, you're going to pay taxes on that 50,000 even though you haven't received it. So obviously for smaller business owners, that puts them in a tight position because you're paying taxes on money you haven't received. The purpose of accrual is to better match income and expenses based on timing, especially when you have, maybe a 4 or 5 month gap or maybe even a year gap, between when you're incurring expenses and when you're receiving the income from the client. So it could be a good fit in certain situations. I've seen where those in the travel industry, for example, they collect money for trips over a year period of time. Expenses are incurred over that year period of time, but the trip doesn't occur till the following year. That may be a better fit for them because it's matching the expenses and income and the recognition of the earnings, for example, when the trip is complete. So there's situations where accrual could be a good fit, but generally I've seen that a cash basis taxpayer is a better fit for smaller business owners so that they're paying taxes based on cash received. Another thing to understand when dealing with accrual versus cash is that your record keeping on an accrual basis is a lot more intense, it's a lot more detailed because you're recording bills as you receive them. You're recording income as you are earning over time, and your expenses may be deferred until you've matched it with the earning of the income. So it's not just based on, when you pay the bill and when you receive money. You literally have to put things in ahead of time, defer things until they're recognized. So that recognition process becomes very detailed. You definitely want to work with a qualified professional who's familiar with accrual basis reporting to fully understand that. So, everyone, I had a blast answering your questions today. Again, I'm Safietou Russell, founder and CEO of SDR Consulting Inc. As far as my background, I've been in the industry 20 years and I'm a CPA and enrolled agent and have a master's in tax. SDR Consulting is a virtual firm based in New York where we specialize in working with business owners, especially those in the mental health profession, to help them reduce their concerns regarding tax and accounting so you can focus on your clients, your patients, and also your own well being. I also have a business startup basics course, which would be a great fit if you're just getting started, or if you've started and don't really know what you're doing. It will cover basics about different entity types, pros and cons, how they're taxed. It'll cover business bookkeeping basics, tax write-offs, as well as a little bit about tax planning. And that course can be found on sdr.teachable.com. If you'd like to schedule a free 15-minute introductory call with me, you can schedule by calling the office at 516-255-6603, and you can find me online. Our website is www.sdrconsultinginc.com. Take care. Bye-bye.